We've spoken a lot about supply, but tell me how you're reading the economic situation in these large importing economies like China and India, for example. I think China is particularly interesting, just given some of the numbers that we've seen coming out of the economy over the last couple of quarters. Is China demand intact, and what's the long view run rate when it comes to how much energy China will actually be importing?
Maybe I start first with India, as we just got the data for June, which surprised positively. So there the trend will continue to be of higher demand. It's seasonal, so there will be a month-on-month decline going forward, but year-on-year it should be higher. And going forward, I guess India will become the driver of oil demand growth. To China, the data set is a bit more mixed just because there is no official data releases from the Chinese government, or comes out with a huge delay, so it's a guesstimate at best. But what we hear from different market participants is that demand in China looks a bit better than everyone is talking. We are not talking of booming demand, but it's not collapsing or very disappointing. So there is a positive trend. The challenge there is that inventories in China are increasing, so we don't know if it's strategic purchases or demand weakness. I would say potentially more strategic purchases. But essentially going forward, the growth rate will be more dependent about the petrochemical sector. The transportation sector is less in need of oil just due to the massive rollout of electric vehicles.
Indeed. And so all of this is ultimately impacting where oil is going to be trading. Gio, what would you say is the biggest risk to this market, though? We've spoken a little bit about the potential for a new flare-up in terms of the conflict and the escalation cycle in the Middle East. We've spoken about the outlook for these importing economies. Is there anything else that you're looking at that could potentially disrupt the pricing structure as it exists today?
I would put it slightly different and not call it risk. Volatility is an element which is not helping in the oil market, and what President Trump does with his tweets and comments is generating volatility in the market, and that makes the life of consumer and producers more difficult. So this is a bit the challenge that I see. I wouldn't call it a pure risk, but a challenge for the oil market.
It's not new though, is it? We know that we've seen this movie before, right?
It's correct.
Right.
But it got more extreme this year.
More extreme, right. Okay, so in terms of the US policy announcements, then what concerns you the most? It's obviously trade and tariffs that have been dominating market sentiment, but is there anything that concerns you with regards to what the president has said?
What we have heard is that he wants, on the one hand, to have lower oil prices, and this is a bit a challenge then for US producers. Current prices are not attractive to drill, and we see a decline in drilling activity. In the past, it was non-OPEC plus supply growth driven by the US, and this is a bit a change that this supply, which is more flexible on short-term reaction, it takes months to bring online shale production, will not materialize. So there is a disruption in that perspective, and you move towards more countries which have spare capacity to react to disruption. At the same time, the demand trend, you don't know what could come next, what it means for economic growth. Is there low economic growth, disruptions in that sense? So it has an implication on the supply and demand side, and that's a bit the challenge that I see.
Is drill baby drill dead in the water if crude falls any further from here?
I would say we moved from the drill baby drill to chill baby chill to freeze baby freeze, and probably we're now moving to cut baby cut.